everyone. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing my North American opening market comment for Wednesday, September 21st. Well, today is the tomorrow you worried about yesterday. The Bank of Japan already announced their decision. They introduced QQE with yield curve control. For details of that, please watch my morning video, which discusses it in detail. Next comes the Fed. I've made a separate video about what they might decide, so I won't repeat everything I've already said. You can watch that one for more details. In short, I expect that they won't hike rates this time, but will leave open the door to a possible rate hike in December. The market sees a 22% chance of a rate hike today and a 58% chance of a hike by or at the December meeting. Now, if they don't hike rates, the important point will probably be how they adjust their forecasts for the Fed funds rate to take into account the fact that the new set of forecasts will now extend out to 2019 instead of ending at 2018. I expect that they'll keep their terminal rate, the end rate the end level of Fed funds, unchanged, and use the extension just to project a shallower, a more gradual pace of rate hike increases than before. That's likely to be negative for the dollar. Now, traders who are interested in taking a position ahead of the FOMC meeting should probably look at using either euro-dollar or dollar-yen. These two have both a relatively wide range on FOMC days, that's the x-axis in this graph, and show an unusually high increase in that range over the range in the average day, that's the y-axis. The yen especially is likely to be volatile, as the market also tries to figure out what the Bank of Japan decision means. The high beta Swedish krona, Australian dollar, Norwegian krone, and Kiwi, New Zealand dollar are even more volatile, as you can see from the graph, but then again, their spreads are wider too. This time, though, the New Zealand dollar could be particularly volatile, given the Reserve Bank of New Zealand, RBNZ, meeting a few hours later. With all the attention focused on the BOJ and Fed, the RBNZ meeting is likely to be an afterthought for the markets. Economists unanimously expect no change in rates this time, although the market does think a cut's likely by the meeting next February. While the RBNZ may try to talk down the New Zealand dollar, that'll probably be difficult if the Fed does lower its expected path of rate hikes. Such a move would only make the New Zealand dollar's relatively high interest rates, the highest in the G10, even more attractive. Even if the RBNZ does cut rates, it would still be tied with Australia. Meanwhile, New Zealand's economics are pretty good. Its housing market's strong, consumption data is solid, dairy prices are rising, as you can see from the graph, and growth is accelerating. The Kiwi may be one of the major beneficiaries of the Fed move if, as I expect, the Fed remains on hold tonight. As for the economic indicators, the only one due out today is the weekly U.S. oil inventories from the Department of Energy. They're forecast to show a large 3.25 million barrel a day rise in crude inventories and only a modest decline in gasoline inventories. However, the API report overnight showed a huge 7.5 million barrel fall in inventories, which caused oil prices to spike. So we really have no idea what to expect from this release. The Canadian dollar gained on the news of the API report of a fall in inventories. It'll probably be volatile again this afternoon. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.